Welcome to Under the Basswood Tree with Basswood Counsel, a podcast where we bring you brief, valuable conversations and insights to help you navigate the complex world of business transactions. From cross-border deals to international tax structuring, we cover topics across all industries. Our team and colleagues will share their insights and provide practical tips on key issues for you and your business. Let's get started.
Once again, thank you for everyone for joining. We're going to now talk about the One Big Beautiful Bill Act, specifically some tax planning opportunities or what the changes were, both on the individual side and for businesses. This is some sweeping tax reform that was passed. Some of it was to extend the 2017 Tax Cuts and Jobs Act, which had some expiring provisions. Others, there were some business favorable changes. A lot of the clean energy credits kind of are phasing out or going away. So there's a lot of change that occurred, but we're going to cover some of the highlights. So Gina, on the state and gift tax side, what's changed under we'll call it the OBBBA. Or call it OBBA.
OBBA. Yeah, so just as an update on the estate and gift tax, the estate and gift tax exemption amount and the generation skipping transfer tax exemption amount was temporarily doubled under the prior 2017 Tax Cuts and Jobs Act. And that was going to sunset at the end of this year. The exemption amount for 2025 is approximately $14 million per individual. And the OBBBA prevents the sunset and instead permanently increases it to $15 million per individual starting next year. And it's going to continue to be indexed for inflation. So while this may impact only high net worth individuals, it's always a good idea for you to review and reassess your estate plan. And especially if you live in states where there are lower exemption amount, I think it's a good opportunity for you to make sure that it's aligned on your estate plan.
So there's, certainly planning opportunities there. One key thing to remember, even though this is made permanent at $15 million, this is a highly contentious, it doesn't make the government much money at all, but it's a highly contentious area that one side likes a lower estate tax exemption because having a too high one, they think favors, wealthier individuals. The other side wants a high estate tax exemption or maybe none because they believe it leads to better business or that the estate tax will actually kill some small businesses because to pay the estate tax, they have an illiquid asset. And so while the exemption is high and some of the clients may be just underneath the level, they may want to do some planning to hopefully ensure that they don't lose the opportunity.
Yeah, and in the coming years, we say it's permanent, but there's always a chance that the government might change it, lower it, depending on who's going to be office. So, always good to be updated. Yep.
What are some of the key highlights for the individual income tax?
Yeah, so on the individual tax side, the OBBBA introduces a wide range of provisions intended to help or benefit the low and middle income taxpayers by expanding various credits and deductions. Some of the key measures include higher standard deduction, increased state and local tax cap from $10,000, and now it's increased to $40,000, some enhanced child tax credit and adoption credit. There's a new universal $1,000 per person charitable deduction for non-itemizers, because usually you have to itemize in order to deduct a lot of your charitable deductions. But right now, under the new law, they give you that $1,000 even if you don't itemize. There are also enhanced education-related benefits for especially the 529 plans and American Opportunity Credit. And there's also an introduction of new tax-advantaged savings vehicles known as the Trump account.
I heard the government will actually donate to new children, new kids that are born. Is that correct?
Yeah, only during the years of 2025 and 2028, though.
Will the statement say Trump account on it?
Hopefully, I don't think so. I should keep the political side out of it. But I think President Trump really intended to leave a lasting legacy through this. But yes, the government will donate $1,000 per each account open for these children born between 2025 and 2028.
And I would say in this area that what's especially a lot of times in blue states that have higher income taxes and property taxes is what they call the SALT cap. And that was the $10,000 limit that Gina was mentioning that got increased to $40,000. So That would be a big item for taxpayers. About starting into business tax.
Yeah, I'm just gonna touch upon a couple of key business tax updates for sole proprietorships and pass-through entities, or taxpayers with pass-through entities. They were able to claim what's called business income deduction, and you were able to deduct 20% of your income. And now under the OBBBA, they increased the deduction percentage to 23%, and they made this permanent. And it also raises the phase-out income thresholds to $75,000 for single individuals and $150,000 to joint filers. It used to be $50,000 and $100,000, but now the thresholds have been increased. So it should benefit and be more accessible to higher income taxpayers, like the ones who have specified service trade or business, like the ones in law, health, and consulting.
Yeah, if we take a step back, so the purpose of this pass-through deduction is back in 2017 with their Tax Cuts and Jobs Act, the corporate income tax went from a high of, I think, 35% down to a flat rate of 21%. So then that raised, is this now favoring C Corp tax over pass-through entities such as S-Corps, partnerships, and disregarded entities? So this deduction, by giving it used to be a 20% deduction, now a 23% deduction, can raise someone in the individual in the tax top tax bracket from having a tax at at 37%, having a top tax rate on their business income. It's not to everything. Business income, you get the full deduction of about probably 26, 27%. I haven't done the math with the new enhanced amount. Mm-hmm. But sorry, what else is happening?
So another thing was, I'm pretty sure everybody knows about that bonus depreciation for business assets purchased for the first year. So that was getting reduced every year by 20%, but now they are making it at 100% again, starting with the business assets purchased around January 19, 2025. So it is going to continue at 100% or going back up to 100%.
Yep. So that's helpful.
Yeah. And, the OBBBA has significant impact on a lot of the businesses. So we'd like to discuss in more detail on some of the other key provisions. And I want to start with the research and experimental expenditures and, what was the requirement before the OBBBA, Chris, and what change was made?
So we'll just call it R&D expenses. And so there's two sides to it. There's a tax credit you can get for R&D, and then you can expense or amortize the actual cost. Before the 2017 Act, you could expense expenses related to research and development, which makes a lot of sense. Companies around the world or countries around the world are fighting to companies to do research and development in their country because it brings good jobs to the people in the country. And so expensing makes a lot of sense. And in 2017, with a lot of tax laws that are changing, they did it through a budget reconciliation process, meaning you only need, I don't know, is it 60% of the vote or maybe it's 50% of the vote instead of a higher percentage. Under that, you have to level the budget through the things that are happening in the Act. So to do that, to get the other tax laws passed, starting in 2022, they changed research and development expenses from being expensed to being amortized. What amortized means, let's say in 1 year, your research and development costs, including wages, by the way, was $1 million. Instead of expensing $1 million, in the first year, you only got to expense 10%, so $100,000. That was killer for small companies, and we had a client in this position. Let's say the company had $20 million revenue, $2 million R&D expenses in the first year, so 2022. So I think I said 20 and 21, so 20 million.
20 million and 2 million.
So their cash flow negative 1 million, but because they have to amortize that R&D expense, they can only take 10% of that expense, so they get 200,000 instead of 2 million of a deduction. They now have significant taxable income. And where do you get the money? Is cash flow was not positive. And that really caused a lot of small to mid-sized businesses, specifically in software development is one where it was big, but in other research and development areas, to have a really hard time because they didn't have the money. So a couple of things happened in this in the OBBBA. First, they switched it to where you can expense it from, is it 2025 and 2024 and going forward. However, we still have the issues with 2022 and 2023. For certain businesses with revenue each year of 31 million or less, you could amend the returns and then claim it. So that was a big opportunity for a lot of businesses. Some of the clients we had, simply kind of had to go into payment plans. You want to try to talk to the IRS about this? They go, well, on the tax return, it says they have $1 million of income, so why can't they pay their taxes? Well, it's explained the cash flow problem, but the person that's talking to you on the phone doesn't see it. And so, you have to really work out the solutions. And then your clients are like, well, what do they mean they don't understand? I don't know.
Phantom income, but they...
Yeah, so I mean, so a big problem with phantom income where on tax side, it says you have a lot. In reality, a lot of these companies did not, especially when they're at the beginning of what they're creating. There's a lot of R&D expense compared to revenue coming in. So this was a big help, this change in the law. The next is one of my favorite subjects, which is qualified small business stock. This has been around since even before 2000, I don't know, maybe. But it's been around a long time in various variations. At first, what qualified small business stock does is it only applies to C corporations. If you hold the stock for 5 years, then you can exclude a certain amount from capital gains. So you need to sell the stock. That's key. And with that, at the beginning, the exclusion, you would get 50% of it. So it says you exclude $10 million from capital gains tax, but you could only exclude 5. So you got a $5 million exclusion. Then eventually in 2010 or so, they bumped that up to 75%. And then eventually, and this was even before the 2010 Act, they increased to 100% deduction. So that really helped out. It's a big exclusion now, $10 million excluded from capital gains. Well, the OBBBA made it even more. Under prior law, the capital of the company to get this treatment could only be $50 million at the time. Now that they bumped it up to $75 million. So now there's a bigger scope of investors who come in that can get the treatment for each company. 2, they've increased the exclusion amount to $15 million. So it's a much bigger exclusion amount. And where I come into this, and I see this a lot with when I come in with startup companies or just companies, period, a lot of advisors, they might generally know about it, but they don't know enough about it to advise their clients that this may be a good idea. If a company's plan to get out is to be acquired by someone else, this exclusion is huge. And so when figuring out, well, income tax rates, double level of taxation, you kind of got to scope out, well, a potential exit at the end is a sale of stock, and I can exclude $15 million. You got to put that into the analysis. And what happens a lot, I see a lot with S corporations, I think are great for professional services companies, but there's a lot of limitation on who can be owners. They can't get this qualified small business stock treatment, and it's hard to transition it over so that the business can get it. What the S corp is really good at is by paying payroll taxes for, when you have 1 or 2 owners instead of self-employment taxes, you can get a good spread. So for smaller businesses, especially in professional service industries, S corps can make a lot of sense because a 15.3% savings on $100,000 of income is pretty good. And so, that advantage phases out at certain points, but you got to think through all this when selecting an entity. And the qualified small business stock treatment needs to be a part of that thinking. If you're in a tech startup or something that can kind of explode in value, and it's a real benefit excluding $15 million.
Yeah, Chris. So I think a lot of startup businesses get advice from accountants and attorneys also about there are so many benefits to S corps. So you should do that S corp election. But what should the business owners think about when they're trying to get that entity selection decision?
Well, they really need to think about full scope. Is this going to be a family business? You always might think it's going to be, but are you looking to transition it to your kids and it should go on forever in the family? What can it qualify for qualified small business stock? So for example, a law firm can't qualify. So you got to make sure you're within the service industry that can qualify for this treatment. So you're thinking about what's the plan,
Goals.
What are the goals, but what's the business operations? What's the tax going to flow through on an individual tax return compared to maybe a corporate tax return? Do they have a set kind of exit strategy? They want to build it for 5 to 10 years to get out. And you just really have to think full circle about all of it, how they get compensated, what the exit strategy is, what the operations are, how's income going to flow through, and kind of determine what's the best entity. But I think for a business that's looking to be acquired, the qualified small business stock treatment gives you such a great benefit that it's hard to overcome.
Yeah, and I'm going to switch over and talk about qualified opportunity zones. I know it's been it's been around, and I think it started a few years ago. But I think the OBBBA also had some enhanced features added to it. So could you talk us about it?
And so the qualified opportunity zones were passed in the 2017 Act. It really didn't. There was some stall in the market because the regulations didn't come out until the end of 2019, and some of the benefits phased out in 2026. And to get the maximum benefit, and I'll explain them in a second, you had to hold it for 7 years. Well, we didn't know what the rules were until a day before the 7-year target ended. Couldn't really get the benefit. There was another 5-year target, but I'll explain. Opportunity zones do 3 great things. First, they defer tax until a certain date. So if you sold something and under the first act, it was only capital gains, created capital gains, you could defer gain until 2026. Unless you got rid of that interest in the qualified opportunity fund. 2, if you held that stock for 7 years, the gain that you recognized would be reduced by 15%. If you only held it for 5 years, which probably happened to a lot of people because they didn't get the regulations in place, so everyone didn't know how it operated. If you held it for 5 years, you could cut that gain by 10%. So you get tax deferral, gain reduction. Then if you hold the stock for 10 years, the gain from when you bought the stock in the qualified opportunity zone to what it is 10 years later, or when you end up selling it, is tax-free. So there's a tax-deferred benefit. So there's really great, there's really great opportunity there. What the new act does is it allows the capital gain deferral. Well, it's permanent. So kind of the opportunity zones under the first act, the benefits kind of ended, some of them ended at 2026 based tax deferral. No reduction in basis. So now starting in 2027, so you have to wait a year if you want to use this plan, or a little more than a year, you can now sell something that creates capital gains or even defer $10,000 of ordinary income, roll it and you put it into qualified opportunity fund. And if you hold that interest for 5 years, first you get tax deferral for the for the lesser of when you sell it or 5 years. So you get up to 5 years of tax deferral again. If it's a regular fund in a regular opportunity zone, and there's a new kind of fund out there too, then you get a reduction in what you recognize as gain by 10%. So again, 10% haircut. And similarly, you can, you hold it long enough that the gain in the stock, you don't have to recognize from when you bought it to when you sell it, the 10-year rule. There's a new rural, if the qualified opportunity zone is in a rural zone, then you can reduce the gain, not by 10%, by 30%. So that can be a significant tax savings. It'll probably push some investment into more rural areas, which can be a good thing. Where this also comes in is business exit strategy planning. So there's a lot that happens when a business is getting acquired. And you have the qualified business stock that we've discussed as an opportunity. There's some charitable opportunities where if you can do it the right way, there's charitable remainder trust, charitable lead trust, where yes, there's a charity component to it, but by the assets growing tax-free within the trust and getting an annuity interest out, or on a lead trust getting the growth afterwards, you can do better. Because if you sell something, you instantly recognize, let's say, a 40% tax or whatever it might be. So that's a haircut of 40% of what you realize. But if you put it into a trust, you can reinvest 100%. And yes, you'll pay some taxes, distributions come out, but when it happens right, you can come out better. So what the qualified opportunity zone does in this area is it gives you another tool of how can I defer the tax, invest it in something, decrease the amount recognized, and the growth of that, if it grows and I hold it long enough, not recognize the tax. So it's a really big benefit. Those are the main areas that we want to highlight under the One Big Beautiful Bill Act that was just passed. And maybe we'll take some time for any questions if anyone has any. Yes.
Quick question. We get this question sometimes from our clients, especially with the big bill, the Big Beautiful Bill, is the SALT, the state and local taxes. That's pretty big, from 10 to 40,000. Now, is it only available if you own itemize? If somebody's doing a standard deduction, can they still do SALT, or it has to be an itemized, which I feel is the answer, right?
Correct. You do have to itemize, unfortunately, in order to take advantage of the higher SALT cap. And there's also the income limit as well. If you make too much money, of course, you can't take advantage of it. It goes down to 10,000. If slowly phases out as your income grows. But yeah, unfortunately, you do have to itemize.
But one thing I would say is the ability to take the SALT cap will create more itemizers, which will also create more people who can get the benefit of a charitable deduction that's usually taken out of itemized return.
So with the QSBS treatment, if somebody's already got a business set up that they've been running, can they still try to get QSBS if they've got a few more years to run?
Well, they're going to need 5. Well, I think you can start getting benefit at 3 year. You get 50%, 75 at 4, and 100, I forgot to mention this, 100% at 5. It can, but it can be hard depending on what type of entity is tax classified at the time. So disregarded entities and partnerships can more easily be re-pushed into a C Corp status and get the QSBS status. S Corps are more difficult because of the original issue requirement. And so if it's already stock, when you go from an S to a C, you're really just saying, it's still a corporation, we're just changing the tax treatment. And so those require a lot more kind of detail. Yeah. But yes, you can still get it. All right. And you'll get to exciting securities and corporate next.
Regulatory. Yeah.
All right. Thank you.
Thank you. Thank you.
We hope you enjoyed this episode. To stay up to date with the latest legal insights and Basswood events, please follow us on our Basswood Counsel LinkedIn page and visit our website at www.basswoodcounsel.com. Thanks for tuning in, and we'll speak to you next time.